One of the benefits of being active in the crypto community is that you have the opportunity to interact with a wide variety of individuals and provide guidance on whether or not they should put their money into a certain project. However, solely seeking investment advice or the views of industry professionals is not always a viable option. There's no such thing as a universally applicable standard size. What was successful for other people may not always be successful for you. Because of this, it is the utmost importance that you have created an investment plan that will assist you in preserving a well-balanced crypto portfolio. In this video that we have for you today, we will go over some of the easy ways in which you can accomplish your crypto investing objectives with the assistance of an effective portfolio diversification plan. Before we proceed, kindly subscribe to our channel and hit the bell icon to stay updated on our new videos. Without further ado, let's get started. To begin, let's address the question, what exactly is a cryptocurrency portfolio? A description of all the cryptocurrencies and tokens that you have in your possession is what is known as a cryptocurrency portfolio. It is a representation of your complete investment across the board, including all sorts of cryptocurrencies. For instance, if you hold 10 various types of coins and tokens, then your portfolio is composed of 10 distinct cryptocurrencies. Your total portfolio worth is equivalent to the sum of the values of all the cryptocurrencies that are included inside it. When you start putting money into additional cryptocurrencies, the range of assets represented in your portfolio will increase significantly. You may run into some difficulty trying to maintain tracks on all your investments at some time. In this scenario, it might be beneficial to download some kind of portfolio tracker. This tracker, which can take the shape of either an app or desktop software, gives you a bird's eye view of the performance of all your assets in a single look. You have complete control over the breadth and depth of variety included in your portfolio. For instance, beginning investors could have a modest portfolio that just contains a few tokens at this point. For trading, investors with a greater level of expertise can create a portfolio that is very diversified and consists of several different cryptocurrencies. With so much uncertainty surrounding the year 2022, what is the most effective strategy for managing your cryptocurrency portfolio? The following are the top 5 ways. Number 1. Understanding your risk appetite. Managing your exposure to potential losses is one of the most important things you can do as a trader if you want to turn a profit. It is the distinction that may be made between a novice trader and a seasoned one with the least amount of effort. It is imperative that you first determine if you are a high-risk, medium-risk, or low-risk trader before engaging in any kind of trade. When you are just starting, it's not typically considered to be the greatest practice to take excessive risks. It's also not a good idea to participate in trading with money that has been put aside for an emergency fund, since there is a possibility that you might end up losing the money. Number 2. Be rational. The prices of cryptocurrencies are known for their high degree of volatility, which manifests itself as huge swings in either direction. In addition, blockchain technology, which is the underlying infrastructure of cryptocurrencies, is a technology that is still in its infancy, but is showing great potential. Despite this, try not to allow the hype that surrounds the situation to send your emotions into overdrive. The fear of missing out, sometimes known as FOMO, is a primary factor that contributes to traders' inability to successfully manage their portfolios. Emotional decisions almost always result in the purchase of an asset at a higher price, which is followed by a significant price decline when the market experiences a correction. When the market falls by 30%, for example, it's natural for investors to be nervous, since they do not know whether the correction will continue further into the market and become a 70% correction. Those who are successful in trading or investing in crypto always maintain a sensible approach to their plans and objectives. There will still be excellent investment possibilities available for you to choose from to increase the overall balance of your portfolio. The eradication of emotional trading decisions and the development of more disciplined trading techniques may be achieved via the use of technical analysis. All that is required of you is to execute the plan as written. Number 3. Develop a strategic exit strategy. An exit strategy is a necessary component of any excellent plan. According to scientific research, when our trades result in a profit, our brains produce more dopamine, which in turn makes us feel more confident in our decisions. If you don't have an exit strategy, that positive emotion will convince you to maintain your current position even as a positive feedback loop begins to form. The greater the winnings, the more dopamine that is produced, and the greater the production of dopamine, the longer you stay in the trade. Then if the market were to completely crash, you expect that it would recover quickly. In the most favorable of outcomes, the cryptocurrency market experiences another upswing. The correction, however, might be made to continue on and on for an indefinite amount of time. This would be the worst-case situation. Every significant trend comes to an end at some point. Undoubtedly, powerful trends may continue for a far longer time than most people predict. But at some point, the trend will reach its saturation point, and then it will change. Before entering a transaction, a smart trader will carefully consider how they will get out of the trade. By doing it this manner, it is apparent at what price they will exit the trade with a profit and at what price they will exit the trade with a loss. Again, you should stick to your strategy. Number 4. Diversifying your portfolio. Diversifying your assets is an important part of a successful portfolio management approach. People often say not to put all your eggs in one basket. You don't want to lose all of your eggs if the basket falls. Fast-moving, high-performing cryptocurrencies have a lot of excitement around them. Certain of the excitement is genuine, since some cryptos have a bright future and address real-world issues. Even though other cryptos address real-life issues, our society is still dominated by conventional business and financial practices. The combination of two highly volatile and uncorrelated crypto assets may provide exceptional risk-adjusted returns. Many cryptocurrencies are tied to one another, which is poor news for investors. Even though diversifying a cryptocurrency portfolio might be difficult, it is nonetheless possible. Plan out the foundation of your portfolio first. Which cryptocurrencies have huge risk capitalizations, resulting in great long-term growth potential? It's also possible to make money by lending out stablecoins at a high interest rate. Even if the market is down, a piece of your portfolio can be used as a high-yield savings account, ensuring that you never lose money. It's also a good idea to explore investing modest sums of money in high-growth projects. You may still be tied to the entire crypto market, but if one of these projects takes off, the added growth may boost your portfolio's total worth. Also, research up on the basics of the native token of the cryptocurrency you're interested in. Current prices may not accurately represent the genuine utility that a given token contributes to the crypto economy. Number 5. Budget allocation. Some investors are fast to put all their funds into cryptocurrencies. As a result of this, whenever there is a bearish run, people rush to withdraw their crypto assets out of worry that the value will fall even more and that they would have less money available to spend. What is the effect? They often eventually end up selling for a price that is lower than what they paid for it. What is the solution? Establish a budget plan and allot part of your funds, but not all of it, to your cryptocurrency investment. You will be less susceptible to being misled by the market if you do it this way. Building a cryptocurrency portfolio doesn't have to be difficult. It does, however, need a strategy and maybe the use of a portfolio tracker. Even if you don't have any additional funds, dollar cost averaging can help you develop a well-diversified portfolio. Be sure to research before investing, as you do with any other kind of financial investment. How effectively you manage your crypto assets can have a significant impact on the value of your entire portfolio. And that's all for today, guys. If you find this video interesting, kindly give a thumbs up, subscribe to our channel, and hit the bell icon to stay updated on our new videos. Also, feel free to share your thoughts in the comment section below.